SMH, semis, I believe they are going to lead just like they led in the first two legs. They've had a tremendous consolidation, particularly with what happened in the last few weeks. And people have really kicked them out and said, yeah, they're done.
They got crushed, David.
Going into this sell-off, I had 400 and I've kept my 400 target, not because I'm stubborn. I believe, if anything, I'm low. So
how low did they go?
Got below 200. Yeah, I don't know where it is now. It might be just above 200, but got down to whatever it did, 180 or 90 or whatever. So it's more than a double from here and can happen in 6 months. I don't worry about which month or how many months, but potentially could happen in 6 months. That seems insane, right? Except go back and look at the other legs in semis. I mean, we're coming from a higher level than the past ones or what have you, but semis are, kind of the story of this cycle. And AI is still around. It's not going anywhere. There's still a lot of growth there, and it will reignite as the tick moves up. The confusing part is I'm talking about we could be in a recession before the end of this quarter, and normally that's as cyclical an industry as you get. But you've got other things, AI and things that may not be one of the early cyclical unwinds. So SMH 400, commodity-wise, I think materials are going to play. Copper, I have a $6 target. I haven't changed it. And copper got hit hard in that sell-off, and both the producers and the metal. Metal went down to $4, I think, from $5, and it's right back up towards $5. The producers are coming around now. They're just beginning to really catch up again. I think you've got big runs coming. CLPX, I have a target, which is the copper producer ETF. I have a target of 75 on that, and I think it's under 40 as 38, so that's a big run. I think the industrials will play XLI. I forget what they have for target, I think 180. So that's a big run from here. XLD, I have a 150 target on that. I'm not sure where it is today, but also though, financials, I think financials will do fine. XPD is a broker. So there's big runs coming. It's not just the market.
What about the precious metal space?
Well, I raised my target on gold at the same time I did the S&P and NASDAQ raise. I raised my target on gold from 3,400 to 4,000. And at the time I did that, gold had a correction back to 3,000. So,
David, you called the 3,400. I mean, it just crested above 35 before the correction. But in December, what was gold trading at? 2,500? And you called the 3,400 almost.
I had raised my target. My target had 3,000. I raised 3,400, maybe in September. I can't remember. But
when we spoke in December, you were calling for 3,400 gold, and I think it was trading at 27, 2,600 or something.
You're hearing a lot of talk the last few days about gold peaking and going down. I'm a little worried about what I saw on a intraday on the 10-day chart that we could see back to 3,200.
Do you like the senior producers? Do you like the senior gold producers in general?
I do, and I also like the juniors. And more importantly, I think silver is going. I've had a $75 target. So while I raised gold's target, that 75 is still a long ways away. So I left that alone. We're on the verge of a catch-up rally in silver and silver miners. So both the majors and the minor silvers, I think, have plenty of upside ahead. I've got SILJ, I have a target, I haven't changed it, of 35, and the stock's, under 13. So you basically got, 2.5 for almost 3 times your money coming there.
They have really lagged. I mean, they've just been on the sidelines watching this whole thing.
There's people a lot smarter than me in terms of tracking what goes on in the banks and stuff that talk about it being manipulated and held down by the major banks because silver is important to the defense industry, et cetera. I don't know if that's true or not, but for sure it's lagged. What I do point out, though, is that the perception is much worse than the reality. That if you go back to silver's low, well, gold and silver are pretty much tracked. Whereas in a bull market, usually silver does outperform. Silver's almost doubled from, it got down to 18, I think. And got up 35 the other day. And gold's pretty much doubled from 16, 20 back then. So as much as the perception is that silver hasn't done anything and gold's been great, traded alongside each other. So it's more perception and reality. Like I said, that's still historically, it should be catching up now. And I think that's about to happen. But boy, people are down on silver. And part of the reason they're down on silver is really the miners. Silver miners have really not done well at all.
No. Well, with oil trading down, I mean, the margins for these companies, for all these major silver and gold producers?
You go through the big ones and you say that, number one, they should make a lot of near-term earnings because of the margins. But number two, as that asset becomes more and more valuable, they have massive assets in the ground. You just look and say, how come nobody's interested in? I think there's a big catch-up coming. I presume it's because people just assumed gold was going to disappoint again, roll over and go back. But I think they're going to become believers now because it's got momentum. The miners, to me, is probably where the bigger money's made.
I tend to agree with you. Let's talk bust and post-bust. The bust, we've kind of explained, right? I mean, it's just going to be absolute carnage. I'm more interested in, the post-bust reaction and some of those forecasts.
People want to know, why do I have bust as opposed to just a hard landing or just a tough recession? It's because we have 320 trillion or 330 trillion in global debt. We came through a pandemic that everybody seems to have forgotten because it's now several years removed. If you really dig below the surface, that pandemic changed a lot of things and basically put at risk a lot of small businesses and other businesses. Just look at the auto companies. Not only do we have the pandemic, but we had big changes in terms of what the Biden administration put in for climate change and things. So, you look at GM and how much money they put into electric cars. Now they're having to back off because the mandated demand wasn't the same as consumer demand, both in big and small companies, fragility below the surface. You got to look statistically and say, gee, we're far removed from that crisis in 2021. But under the surface, there's lots of businesses that can't find help because of the pandemic. Kids aren't going out to do the part-time work. We doubled our minimum wage. That took care of their margins. They're getting by. Some of them are doing well, but lots of them aren't. I think there's a lot more economic fragility than people realize, or than normally we would have going into a recession. So I go massive leverage plus economic fragility really caused by the pandemic and the changes that happened during that period, plus central bank policy error. Because of what happened in 2008-9 and the decade after that, all the central banks are convinced we can't go back there. It was necessary. And now they determined that it was a bad thing. They're going to make the opposite error. Instead of going too far, they're not going to go nearly far enough.
They're going to wait too long.
And when you're in a bust, if we're truly, I talk about a free-falling banking system around the world or a free-falling financial system, we got a little taste in the last few weeks just from markets. But if it's the whole system, it can unwind in a hurry. And we saw it in 2008. We almost lost GE. The commercial paper market froze up. So when you hit that magic mark, it can happen in a hurry. Again, I find this is easy part of my forecast is human nature, on two sides. One, I can read Powell like a book. I mean, I know what he is, and I know where he's basing his stuff on. And I've been very supportive of him or defensive of him because he got criticized a lot in the last few years. And I said, if you look at the last year, he was more right than most of us, in terms of by staying the course and not, he brought down inflation without causing a recession in the last year. Now, going forward, I'm going to be a lot more critical, I think, because of what I'm talking about here. But he's sincere and transparent. And what more do you want from him? He's convinced that his mandate is to be like Volcker when everybody else is telling him he should ease, or when he's going to be the big boy in the room that's going to say, no, we got to, inflation's too important. So, it's pretty easy to predict that he's going to be slow off the mark, and slow in two ways. He's going to, on the one hand, be slow to act, and then maybe more importantly, be very measured in his act. So slow to recognize the degree of ease that's needed. It's not just timing, it's right sizing. When do you get your policy right sized to the point where it actually makes a difference? That's going to take many months for him to get there, because on the one hand, we just came through 2008 and it's fresh in our minds of what we did wrong there, or what we did in excess there. So he's fighting that. And number two, you're going to have something even bigger than that, maybe faster than that requires you to move even faster. And you're just the opposite. You're going to be moving slower. So when you put all that together in the soup, you come up with a bust.